Every great story has a beginning. In the world of accounting, your financial story begins with journal entries. Think of them as the opening lines of your business's financial narrative. They capture each financial event, big or small, painting a vivid picture of your company's economic journey. Journal entries might seem like a foreign language at first, full of debits and credits. Don't worry, we'll decode this language together, step by step. By the end of this guide, you'll be well on your way to mastering journal entries and confidently writing your own financial story. This isn't just about numbers, it's about understanding the language of your business. It's about taking control of your financial destiny. So, let's embark on this journey together and unlock the power of journal entries. Are you ready? Let's dive in. Before we dive into the how-to, let's demystify what a journal entry actually is. In the simplest terms, a journal entry is a formal record of a financial transaction. It's like a logbook for your business's finances, documenting every purchase, sale, payment, and receipt. Imagine you just bought a brand new laptop for your business. This isn't just a shiny new gadget, it's a financial event that needs to be recorded. A journal entry would document this purchase, noting the cost of the laptop and how it was paid for. Journal entries follow a specific format using debits and credits, which we'll cover in detail later. These entries are the building blocks of accounting, providing the raw data for your financial statements, like the balance sheet and income statement. Without journal entries, your business's financial story would be incomplete. They provide the crucial details needed to understand your company's financial health and make informed decisions. Every good detective starts with a clue. In the world of journal entries, our first clue lies in identifying the transaction. Before we can record anything, we need to understand what financial event has occurred. This might seem straightforward, but accuracy is key. Is it a cash sale? A purchase on credit? Have we received payment for an invoice? Each transaction has a specific nature that dictates how it will be recorded. This is where supporting documentation comes into play. Invoices, receipts, purchase orders. These documents act as our evidence, providing the details needed to accurately identify and record the transaction. Think of it like piecing together a puzzle. Each document provides a piece of information, and by putting them together we get a clear picture of the financial event. This careful analysis is crucial for accurate bookkeeping and lays the foundation for a solid journal entry. Now that we've identified our transaction, it's time to introduce the stars of the show: debits and credits. These two accounting principles are the backbone of journal entries, ensuring that the accounting equation always remains balanced. Think of debits and credits as two sides of a scale. Every transaction has two sides. Something is given and something is received. Debits and credits help us maintain balance by recording these two sides for every financial event. But here's the catch. Debits and credits don't necessarily mean increase or decrease. Their impact depends on the type of account involved. This is where things can get a little tricky. Understanding the rules of debits and credits is essential for accurate journal entries. It's like learning the rules of a game. Once you understand them, everything else falls into place. Section 5. Decoding debits and credits. A closer look. Let's break down this dynamic duo a bit further. The golden rule to remember is, debits increase asset and expense accounts and decrease liability, equity, and income accounts. Credits increase liability, equity, and income accounts and decrease asset and expense accounts. Think of it this way. Assets are what your business owns. When assets increase, we debit the asset account. Liabilities are what your business owes. When liabilities increase, we credit the liability account. Equity represents the owner's stake in the business. When equity increases, we credit the equity account. Income is money earned from business activities. When income increases, we credit the income account. Expenses are costs incurred to generate revenue. When expenses increase, we debit the expense account. Confused? Don't worry, it takes practice to get comfortable with these concepts. The key is to remember the basic rules and apply them consistently. Section 6, Step 3, Writing the entry, putting pen to paper. Now that we understand debits and credits, it's time to put pen to paper, or fingers to keyboard, and write our journal entry. A journal entry follows a specific format to ensure consistency and clarity. First, we record the date of the transaction. This helps us maintain a chronological order of events. Next, we list the accounts affected by the transaction. The debit account is listed first, followed by the credit account, slightly indented. This indentation visually separates debits from credits, making the entry easier to read. For each account, we record the amount being debited or credited. Finally, we can include a brief narration below the entry to provide context and explain the transaction. This structured format ensures that journal entries are clear, concise, and easy to understand. It's like writing a story. We want to present the information in a logical and organized manner. Section 7, Step 4, Double-checking. A stitch in time saves 9. We've written our journal entry, but our work isn't done yet. Before we move on, it's crucial to double-check our work. A small error in a journal entry can have ripple effects, impacting the accuracy of our financial statements. The most important rule to remember is that debits must always equal credits. This ensures that the accounting equation remains balanced. So take a moment to add up the total debits and total credits in your entry. Do they match? Next, review the accounts you've chosen. Do they align with the nature of the transaction? For example, if you've recorded a cash sale, have you debited the cash account and credited the sales account? This step might seem tedious, but it's essential for maintaining the integrity of your financial records. Think of it as proofreading an important email. Taking a few extra minutes to review can save you from potential headaches down the road. Section 8, Step 5, Posting to the ledger, the grand finale. Our journal entry is complete and double-checked. It's time for the grand finale posting to the general ledger. The general ledger is the master record of all your business's accounts. It's where we track the ongoing balances of each account. Posting simply means transferring the information from our journal entry to the relevant accounts in the general ledger. For example, if we've debited the cash account in our journal entry, we'll post this debit to the cash account in the general ledger. This process ensures that our accounts are always up to date and reflect the latest transactions. It's like updating your checkbook. Each transaction is recorded to provide a running balance. The general ledger is a powerful tool for financial analysis. By tracking the activity in each account, we can gain valuable insights into our business's financial performance. Section 9, a simple example, bringing it all together. Let's illustrate these steps with a simple example. Imagine your business purchased office supplies for $100 in cash. Here's how we'd record this transaction. Step 1, identify the transaction. This is a cash purchase of office supplies. Step 2, determine debit and credit accounts. We've increased our office supplies and assets, so we'll debit the office supplies account. We've decreased our cash and assets, so we'll credit the cash account. Step 3, write the entry, date November 9th, 2024, account office supplies, debit $100, account cash, credit $100, narration, purchased office supplies with cash. Step 4, double check debits, $100, equal credits, $100. The accounts chosen align with the transaction. Step 5, post to the general ledger. We'll debit $100 to the office supplies account and credit $100 to the cash account in the general ledger. This simple example demonstrates how journal entries capture financial events and impact account balances. Section 10, the power of journal entries, why they matter. Journal entries might seem like a tedious accounting task, but they are much more than that. They are the foundation of your business's financial story, providing a chronological record of every financial event. These entries are crucial for accurate financial reporting. Journal entries form the basis of your financial statements, providing a true and fair view of your company's financial position. They also support informed decision-making. By analyzing journal entries, you can identify trends, track expenses, and make informed decisions about pricing, investments, and more. Moreover, they help in fraud prevention. The double entry system helps prevent and detect errors, ensuring the integrity of your financial records. Mastering journal entries empowers you to understand your business's financial health, track its performance, and make sound financial decisions. Section 11, Conclusion. Your journey to financial clarity. Congratulations! You've taken the first step towards mastering journal entries. Remember, it's a journey that requires practice and patience. Don't be afraid to ask questions, seek guidance, and embrace the learning process. As you become more comfortable with journal entries, you'll gain a deeper understanding of your business's financial story. You'll be able to confidently track transactions, analyze financial data, and make informed decisions that drive your business forward. So embrace the power of journal entries. Let them guide you on your journey to financial clarity and success.
Commit your way to the Lord, trust also in him, and he shall bring it to pass. Psalm 37 verse 5. I can do all things through Christ who strengthens me. Philippians 4 verse 13.